Hello, fantastic people. Welcome back to the Capitalist Investor YouTube channel. My name is Ben, and on today's video, we are going to talk through why you should be investing for the long term. Before we get into today's video, guys, please do help me out by hitting the like button on this video. It does help with the YouTube algorithm to get this video out to more people. And if you are feeling extra generous, as it says on there, please do hit the subscribe button to be notified when further content is delivered from my channel. That being said, guys, let's get into today's video. So the first point I'd like to make on why you should be investing for the long term. It says on the screen there, over 87-year average, the S&P 500 has returned at 9.5%, which is a fantastic return. Now, many people will say, but if I invest for the short term, I could get gains of 30 to 40%, as seen on sort of Tesla and things. But a consistent 9.5% over your investing career, which can be 30 to 40 years, is a fantastic return with the less risk than putting all your eggs in one basket, such as Tesla. We'll come on to that a bit more in detail a bit later in the video. So yeah, consistently delivering returns. And it's not just the S&P 500. Obviously, other markets have similar returns over a long space of time. And that brings us on to point number 2, really, which is the opportunity to ride out highs and lows. So stocks were meant to be held for the long term. If you think about it, you are buying part of a company. And if you're buying part of a company, you don't just buy a company one day to sell it the next day, because that's not what companies were set up for. Companies were set up for to generate a profit to then pay a dividend to the shareholders and return value. So buying and selling on the short term doesn't make sense and wasn't the reason why they were set up. In addition to this, it is not unusual to see 10%, 20% gains in a day, but also 10 to 20% declines in a day. And actually, this is quite an apt point right now, because what you can see if you go onto your stock app and look at the S&P 500, you'll actually see some huge decreases in tech stocks over the past 2 days, mainly Tesla, CrowdStrike, one that I particularly own, and they've decreased significantly over a very short space of time. And if you're investing for the short term, looking to just get those gains in a very short period of time, you may well be caught out by these pullbacks that the market always has. The market operates on a cycle. So effectively, you're going to have a bull market and a bear market. Bull market being where the market is rallying completely upwards, so the trend for stocks is completely up. And a bear market the opposite way, so stock prices are falling. Now, this is the way the market operates. It goes up and it goes down. Now, obviously, if you are a long-term investor, you're going to have many of these cycles through your investing career. Whereas if you're a short-term investor, you could get very lucky and just ride the highs and sell. Or you could get very unlucky and buy at the high and sell at the low point and make a huge loss. But the opportunity to ride out those highs and lows becomes much easier when you're investing over the longer period. So the third point I want to make, again, is linked to this, is around investors are typically very poor market timers. So you might have heard the saying, it's not about timing the market, it's about time in the market. So having a significant amount of time in the market to allow for markets to recover when there's bad periods. Now, as humans, we do act on emotion. So if we see the stocks declining and crashing, as we did during COVID back in March, many people panic and then start to sell their positions. And inevitably, the famous saying of buy low, sell high goes out the window at this point, because we're so scared that we're going to lose everything that we start to sell and crystallize losses. And this comes back to the point around we act on emotion. What you actually need to be doing is buy it and leave it. And that's what long-term investing gives you. As long as you have an emergency fund and you're happy with the amount that you can invest, you should be investing and leaving. That takes out a lot of the emotion in the market, and I've spoken about this before in one of my other videos. It's quite a powerful tool that you have when you are acting on emotion, you do make wrong decisions. And the final point that I did want to raise was, funny enough, a tax point. I'm an accountant, so I've got to get a tax point in there, so please don't ridicule me in the comments below. But if you are buying and selling constantly, you will end up paying more tax because you're crystallizing gains far more regularly than you would be if you were crystallizing gains later on, and you're effectively more likely to sell really quickly if you're short-term trading, and therefore capital gains tax is going to be paid more regularly than it would be later on down the line. Now, that doesn't suggest that long-term investors don't pay any capital gains tax. They do, but there are tax wrappers such as ISAs in the UK that can prevent you from needing to pay capital gains tax. So, yeah, an accountant point, but I wanted to get it in there for you. Don't ridicule me in the comments, please. So just going to summarize what we've just discussed and why you should be investing for the long term. So point 1, long-term investors always outperform the market. Number 2, emotions hamper returns. 3, over 20-year period, the S&P 500 has always posted a positive return. And 4, riding out temporary losses is a sign of a good investor. It is at that point where it shows a true investor. Lots of these Robin Hood traders are investing with their checks that they've received from the US government into stocks like Tesla, which is driving the price up. But I wonder how many of them were panic selling this week when the stock price started to decline 10%, 15%, 20%. And again, riding those losses out, you can do that if you're a long-term investor. And obviously the market will return to a normal level and give you a decent return based on history. So yeah, I would say I'm very much a long-term investor. That has always been my plan. I don't do short-term trades. I don't do day trading. To be honest, I don't have a clue on it for the long term. As I said at the beginning of the video, I've been Ben, and this is the Capitalist Investor YouTube channel. If you've enjoyed today's content and would like some more, please do remember to smash the like button, hit subscribe, and until next time, guys, I've been the Capitalist Investor. You've been YouTube. Until next time, peace.